All right, let's get right into it. Today, we are tackling one of the biggest challenges for any trader, figuring out the difference between a really strong, profitable trend and one of those choppy sideways markets that just eats your capital for lunch. Mastering this one skill, it can literally be the single biggest thing that changes your trading results. So let's break down exactly how to do it.
I mean, you've been there, right? We all have. You see a setup that looks absolutely perfect. You jump into the trade feeling confident, only to watch it do, well, nothing. It just sits there. Or even worse, it immediately reverses on you. It is one of the most frustrating feelings in the world, and it usually comes down to one critical mistake. And this quote right here, this gets to the absolute heart of the problem. When the market isn't trending, when it has no direction, it's just noise. It's a trap, and it's practically designed to chop up your account. So your number one job, before you even think about placing a trade, is to figure out what kind of environment you're in. Trading in a sideways market is, well, it's like trying to sail a boat with no wind. You're just not going to go anywhere. So how do we actually do it? How do we identify the market's personality? Well, we need reliable tools. And for this system, we're going to focus on a pair of exponential moving averages, or EMAs, on the 15-minute chart. We'll use the faster 20-period EMA and the slower 50-period EMA. Think of these two lines as your compass. They're going to tell you everything you need to know. Okay, now just look at this slide. What's so amazing is how visually different these two market states are. On the left, you've got your strong trend. The EMA lines are steep, they're moving in parallel, almost like a set of train tracks. You can see how the price just bounces off them, it respects them. This is your opportunity zone. Now look at the right. That is the trap. The EMAs are flat, they're all tangled up, and the price is just slicing right through them with zero direction. If your chart looks like the one on the right, your job is simple. Do nothing. Seriously, close the chart and walk away.
But it's not just about whether the lines are flat or steep. These EMAs are constantly telling you a much richer story about the market's momentum. So now let's learn how to actually read their language. This really breaks it down into three simple visual checks. First up, the slope. Are you climbing a steep mountain or are you walking on a flat plain? It's that obvious. Second, you've got to watch the curvature. Are the lines starting to roll over and curve? That is a huge warning sign that momentum is dying. And third, check the distance between the two lines. When they're running tight and parallel, that's a signal of a really powerful, healthy trend.
Okay, so we've used our EMAs, and it looks like we've identified a strong trend. But, and this is a big but, we don't jump in just yet. Now, we bring in a few backup indicators. We don't use these to make our decision. We use them to confirm our decision. This is how we stack the odds in our favor.
Think of this checklist as your final gatekeeper. Everything on this list has to be in alignment. First, the EDX, that measures trend strength, it has to be above 20. Then you've got the DMI, which shows trend direction. The dominant line there also needs to be above 20. And finally, the good old RSI, our momentum gauge. For an uptrend, it's got to be above 50, for a downtrend, below 50. All three of these have to agree with what the EMAs are telling us. Seriously, write this down. Put it on a sticky note on your monitor. This is the golden rule. Trading is a game of patience, pure and simple. We don't predict what's going to happen. We react to confirmed evidence. So, if the EMAs look great, but this checklist doesn't agree, you wait. No exceptions. This discipline is what separates the pros from the gamblers.
All right, we've done the hard work. We've identified a strong trend, and we've got our confirmation. Now for the most important part. The specific non-negotiable rules for getting in and, just as importantly, getting out of a trade.
Okay, for a bullish trade, a call option, the rule is crystal clear. The faster 20 EMA has to cross above the slower 50 EMA. But here's the key. Both lines must show that steep upward slope we've been talking about. A flat crossover doesn't count. That's a classic sideways market trap. We need slope. And for a bearish trade, a put option, it's the exact mirror image. You guessed it. The 20 EMA has to cross below the 50 EMA. And again, you are looking for that steep, aggressive downward slope. No slope, no trade. It's really that simple.
Now, what about those little pullbacks against the main trend? You know, the ones that are so tempting to trade? The rule here is simple, and it's right there on the screen. The number one. If you decide to take these risky counter-trend trades, you only target one level of profit. the very next support or resistance level. These are quick scalps. Get in, grab a small win, and get out before the big trend takes over again. Don't get greedy.
This right here might be the most important slide of all. Knowing when to exit is arguably even more important than knowing when to enter. Your exit plan has to be automatic, no emotions involved. If those EMA lines start to flatten out, you get out. If the setup just starts to look weird or unclear, you get out. And most importantly, if the trade moves against you, you get out. Fast. Don't wait. Don't hope it comes back. Your capital is your lifeblood in this game. Protect it at all costs.
So, this brings us to the final and maybe the most crucial part of this whole strategy. Look, you can have the best rules in the world, the most perfect system, but none of it means anything without the discipline to actually follow those rules every single time. And let's end with this piece of wisdom. This is so important to remember. All those indicators we just talked about, the EMAs, the ADX, the RSI, they're all based on one thing: price. They are followers, not leaders. They only confirm what the price is already doing. So use them to build your confidence, to confirm your thesis. But always trust the raw price action on your chart above everything else.
So I'll leave you with this one question to think about. This system isn't about finding a trade every 5 minutes. Far from it. It's about developing the patience and the discipline to sit on your hands, maybe for hours, maybe even a whole day, and just wait for all the conditions to align perfectly. Can you do that? Because that is the real secret to avoiding the sideways trap and actually profiting from those beautiful, strong trends.